I'm Vern Cushenberry, Chief Investment Officer, and I'm here with another quarterly update. Thanks for joining me. And as usual, I want to give you the bottom line up front. This quarter, I've been asked to address the banking failures and identify if this is going to unfold into a further banking crisis. I've been asked to talk about the recession. Are we in one? Is one coming? And I have a general economic update for you. But the bottom line up front, and I was asked specifically to cast this to an investor who might be in a target date fund, or any investor really that has a well thought out financial plan. The message is nothing that I'm going to talk about this quarter is what I would consider to be out of bounds or something that would knock you off course. So in that light, the message for most investors this quarter is going to be stay the course. Now, as always, I'm going to end this with circle back with your financial planner if you hear anything that causes you concern or raises a little pink flag. But with that bottom line up front, let's just jump right into it. Overview of the markets, generally pretty good, which was nice after last year with the markets being down 18%, US equities anyway. What we saw this quarter were stocks across the board, domestic, international, emerging, global, real estate, all up. Look at international developed, they're up 8%. And even the bond market. I talked last quarter about how fixed income had a very unusual and standout negative return. We're recouping some of those losses this quarter. So good start to 2023. Valuations remain about average. When I say that there's nothing about what I'm going to be reviewing this quarter that I consider to be out of bounds, well, you can see that here with average valuations over the last 30 years. So we've typically seen the price to earnings ratio. That's a very common valuation ratio, but we track a half a dozen more than that. It'll range from 13 on the low end to 20 on the high end, and we're right there in the middle of that range. So no cause for concern or alarm when we look at valuations. Let me look at, okay, I want to jump from this slide deck real quick into some graphics that I flagged to share this quarter about the banking crisis. We saw Silicon Valley Bank and Signature Bank both this quarter fail. SVB was subsequently bailed out. At least the depositors were bailed out. That was a $175 billion bank that failed. Signature Bank was an $89 billion bank that failed. And this is huge news. I always try to remind myself that the media will sensationalize most headlines. And I feel for them. They're in the business of attracting eyeballs and selling advertisements. So to a certain extent, they have to do that. So I went back and I recast these failures relative to the size of the banking system as a whole. When Washington Mutual failed in 2008, that was the biggest failure we'd ever seen. Well, it's 10 years later, and the banking industry, the size of the banking system has nearly doubled. Notwithstanding, Silicon Valley Bank, even adjusted for the size of the system, was still the second largest bank failure we've ever seen. So what does that mean? Are there more clouds on the horizon? Well, for most of you watching this video, is your money safe? Bottom line up front, I think it is. The Federal Reserve has stepped in to implement some pretty historic measures to add safety to the banking system. I want to give attribution to the Visual Capitalist. I took this little snapshot from a website called The Visual Capitalist. It's one of my favorite sites on the whole internet. Flag it. They do absolutely terrific work. And here's another. Okay, let me just bear with me a moment here. Here's another snapshot of our banking system. And you can see here that we're looking at the top US banks as measured by uninsured deposits. So when a bank takes in deposits, anything less than 250,000 is secured by the FDIC. So that gives executives some confidence that their depositors aren't going to engage in that herd behavior where they all come calling on the bank at the same time to get their monies back. That's what causes a bank to fail. So you can take from that the banks that might be most at risk are those that have the largest percentage of unsecured depositors, because those are the same depositors that are going to try to get their money back when they get any kind of negative news. And certainly that's what we saw with Silicon Valley Bank and Signature Bank. So that's just something else to be mindful of there. Now I want to go back to my slide deck here and look at, let's see here. Okay, now I want to go back to my slide deck here and look at some of the causes of that. Both of these banks had a very significant degree of their reserves invested in the bond market. And these weren't risky bonds, these were treasuries. But I covered this last quarter. What we saw last year was very unusual. We saw losses in the treasury market. So what we're looking at here on this slide is the annual returns to just the Bloomberg Aggregate Bond Index. So the whole fixed income world, the aggregate bond index. And we're looking at, in the gray bars, we show the yearly gains and or losses. And the red dots for each year represent the intra-period maximum loss. So last year, we saw the bond market down 13%. And peak to trough, we saw a 17% decline. So these banks, which had a high degree of their reserves in even US Treasuries, they weren't immune from that. So they saw losses mount up in their treasury portfolio, and that when they were called upon to refund depositors' monies, they weren't able to access the treasury markets quickly enough to liquidate some of those investments without taking significant losses. And when the rush came, the banks ultimately failed. So in the meantime, what the Federal Reserve has done is they've stepped in to implement a new term lending facility that basically says, even though you've experienced a 13, 14, 15% loss on those investments, we will loan you 100% of the principal value on those US Treasuries. That's huge. So when I say I think your money's going to be safe, that's a big part of the reason why. Now, are there going to be further bank failures? Probably. That's a typical part of the ebb and flow of the economy. So the economy expands, the economy goes into recession. It's very common to see some bank failures with that, but I don't think we're going to see anything historic. Okay, now I want to move on to this next chart. I shared this last quarter, but it's worth sharing again, because when the fixed income market declines by 15%, what we see is that yields go up. So for an investor with a buy and hold approach, we can have confidence that those monies are going to be returned to us over time, especially those US Treasury securities, because they're backed by the full faith and credit of the United States government. So we look at US Treasuries here. What we see is that over the last 10-year period, their yields have ranged from, call it 0.5% to 4.5% on the upside. We are currently at 3.8%. So towards the top end of that range, that's going to benefit investors over the next 10-year period. And you can see that relationship holds true for munis, corporates, mortgage-backed, asset-backed. Really, the whole fixed income universe is now yielding close to the top of its 10-year range, which is a good thing for investors. And it'll be a good thing for banks too, now that the Federal Reserve has implemented that lending facility. So just a quick review of a slide we touched on last quarter. Are we going into a recession? Well, Magic 8 Ball says probably. Now, the key there is the timing. Is that going to be next quarter, or is that going to be 3 years from now? Like I mentioned, the business cycle is still in full effect. So we will see more recessions. From an investor's point of view, the important part of that is just to recognize that, yes, we've been here before, and we know how recessions unfold. And typically the market reacts in advance of that. So we may have seen some of the anticipation in the decline that we saw last year. One of the pink flags that we're currently looking at is in vacancy rates. We are working ourselves through this post-COVID world, and we know that office real estate is, I don't know, the right word might be challenged. What we've seen are vacancy rates. We've seen these rates before, but they've come at significant inflection points for the economy. what we're seeing today in this post-COVID world is high relative to history, and we're watching how that might all shake out. I don't know about your day to day, but in my day to day, we've gone hybrid, which means we don't need as much space as we used to. We have a lot of desks sitting open, and I know that's pretty common for corporate America right now. So that's at the very minimum going to serve as something of a governor or drag on the economy, or on that sector of the economy, certainly as we move forward. So we're monitoring that a little bit. Okay, now I want to shift gears a little bit. That's my economic update. That's what my magic 8-ball is telling me. I want to wrap up, as I always do, with some long-term investing wisdom. And I share this data twice a year because this is some of the most powerful data that I see in our industry. And it's published by S&P Dow Jones. And they put this report out that they call SPIVA twice a year, and they just published it for the end of 2022. And it's a report card on the mutual fund industry. They take a look at mutual funds across all sectors, and they assess their performance or lack of performance based on whether or not they're beating their underlying index. Because indexes are investable. As an investor, you have the option of just saying, low cost wins. I want to keep my costs low, so give me a little bit of everything. And it doesn't take a whole lot of skill to implement that strategy. So as a portfolio manager, your job, you're really tasked with the job of beating that low cost, naive buy and hold indexed approach. So S&P publishes a report twice a year showcasing how well professional money managers do at accomplishing that goal. And let's take a look. For those of you who have been tuning in for a while, I think you probably know how this story unfolds already. So let's look at this here. The front page kind of tells us what we need to know. This chart details the percentage of large cap domestic equity funds. So these are stock funds, US stock funds, underperforming. So these are, importantly, these are failure rates. What percent of US mutual funds fail to beat the S&P 500 each year? And you can see here that most of the time, that failure rate is up above 50%. So here last year, it was 51% of US mutual funds failed to beat their index. 2021, 85, 2020, 60. We can see 1, 2, 3 years in the last 20 have they been able to, win on average. So that's pretty convicting data right there. And it gets worse because when you take that failure rate and you compound it over time, that discrepancy has a tendency to become magnified. So let me scroll down here to page number 9 of this report, and we'll make this report available on our website. So here's page number 9. What we're looking at here is the percentage of US funds that underperform their benchmark over 1, 3, 5, 10, 15, and 20-year periods. Okay, so take a look at this. As we span out and increase the time frame, by the time we get to 20 years, those marginal wins or losses over time, they compound each other. As investments do, we get a compound rate of return. So any small win in a quarter or a year compounds so that it becomes a large win in a 3, 5, 10, 15, or 20-year period. And you can see here that the failure rates are in the 90s across the board. There's an exception. Large cap value funds only failed 86% of the time. And here we go. Multi-cap value funds have only failed 88% of the time, and real estate funds have only failed 87% of the time. Okay, that's pretty convicting data. Now let's go to the next slide so I can belabor the point just a little bit. I'm going down here. I want to look at the fixed income universe, which is on page 23. Bear with me. So here's the fixed income universe. We are looking at percentage of fixed income underperforming their benchmarks. Again, let's span out to the 15-year column. And we see here fixed income, maybe it's done a little bit better. there's a 69% general bond funds. That universe has only failed 69% of the time. And here is the best performing asset class globally. Global income funds have only failed 57% of the time. Okay, great. Let me just close out of this. I'm going to stop my share there and say, so what's that mean for an average investor? What I'm trying to impose on everybody that's tuned in is the importance of keeping your costs low. The one thing that we know we can control with certainty as investors is our costs. And costs are important because they compound over time. Does that mean that the search for winners is fruitless? No, absolutely not. I've spent my career searching for strategies that win in this market, and there are systematic strategies that we can apply, but we have to be mindful of this data. If we ignore this data, it's to our own peril. So I make sure I share it once or twice a year with all of our investors, and that's my timeless bit of wisdom for the quarter. I'll be back next quarter with another economic update. In the meantime, please send me your questions so I can address content that's on your list of things you actually want to hear about. I'm here to serve you, and thank you for your time. Take care.